Okay, hello everyone. My name is Roman Moiseiev, and I will be talking about stock market prediction utilizing central bank policy statements. This presentation will be structured as follows. We will briefly talk during introduction about background financial information that is required to understand the task and problem setting. After that, we will discuss my data specifications that were collected during this research, following by solution pipeline and the evaluation of obtained results, and conclusion where we will discuss the limitation and also will answer to reviewer questions. So what is goals of central banks? They defined usually as some particular one or a mixture of following: low unemployment rate, stability of prices, and steady growth of the economy. For example, Federal Reserve System of United States have dual mandate, which defined in governmental documentation as promote effectively the goals of maximum employment, stable prices, and moderate rate long-term interest rate, and usually referred in the literature as a dual mandate. And also important point here is that the Federal Open Market Committee, which is part of US Central Bank, meets 8 times per year to discuss macroeconomy and probably take some decision which will be important later. Contrary, European Central Bank, Bank of England, and also National Bank of Ukraine work with different policies somewhat, which is the inflation targeting. And for ECB and Bank of England, we have target of inflation 2%, and for National Bank of Ukraine currently is 5 plus minus 1%. What tools the central banks have in order to reach that goals? The most important one is interest rate, which for the United States called federal funds rate. And how it works basically is this rate on which commercial banks can take a loan from the central bank. And when the rate is cheap, the banks can take this money. They can provide cheap credits to the business. Business can give investment, create workplaces, and pay salary to the workers. And that workers can go to the shop and buy something. And that will increase prices, and that will interfere with goal of central bank to keep the prices stable. So basically what bank can do in that situation can increase that rate, and it affects a whole economy as a system. So there is not a right answer to the question how rate should be, but there are smart economists who work on that. And when economy is growing, rate tends to become gradually higher. And for the green lines on this chart, for example, we have recessions, and we see that central banks support economy during recessions by easing the monetary policy and decreasing this rate. So as a problem formulation, I would like to offer you a case. This is price of Euro stock 50 index, which can be used as proxy to European economy. And we had on the March 7, 2019, statement from European Central Bank on 2 p.m., which is 30 minutes before green line, with some policy action. And reaction to that statement was increase in price. And after that, on 2:30, where the green line is, the president of European Central Bank gave rationale behind that statement. And this communicational component drive prices down to below event level. So the National Bank of Ukraine, in its April inflation report, argues that initial increase in price was due to algorithmic traders, which reacted positively to action and did not include communication in their approach. And we want to tackle that problem by including informational component in such models. So our objectives are the following: collect data, which is crucially important for financial domain. Second thing is construct a meaningful feature out of the Federal Open Market Committee press releases that follow such action with rationale behind it, and assess the market reaction to the whole event. And our research question is the following. Can we, from the FOMC statements, construct meaningful features that will explain market reaction? So the data. First of all is the statements itself. Secondly is federal fund target range, which I was discussed as like most important tool in the box. So, and second one is derivatives on that rate, which is 30-day federal funds future contracts, and stock data itself. So for FOMC statement, it usually looks like that. We've collected 174 items, and they ranging from 500 to 6,000 symbols, and we assess the label data for these statements, which will be discussed later, for smaller period with 96 items. And worth to mention that in label data we have timestamps for these policies, but for other data we need to manually find timestamps on sites such Bloomberg, Reuters, calendars, and volatility analysis in order to manually find these timestamps. So second is in federal funds target range. Like before 2008 crisis, it was single number, but starting from the crisis, it became the band with 25 basis points spread. Okay, and federal fund futures, if you notice, they are like inverted to the federal funds, because the actual calculation is 100 minus expected federal funds rate for that months, and that's how price is calculated. So about stock market, we choose SPY exchange traded fund, which is proxy to US economy, to the index of Standard & Poor's 500, which is basically tracks 500 largest publicly traded companies in US based, and this ETF can be traded. We can buy and sell it, but index cannot be, so we choose that one. And our period of investigation is starting from 2011, and it's like longest bull market run in the history. And we have like increase in price with minor corrections. So the case. Let's imagine our SPY on December 19 of 2018. We have press conference of Federal Open Market Committee scheduled on 2 p.m. And 5 minutes before that, we start working with our task, because we are not sure about particular timestamp because it's not in official data. So what data do we have? We have federal funds futures, which can be used to extract implied probability and somewhat market expectation of action. Second thing that we have a lot of economic key indicators that can be used and used by actual committee members to make the decision about monetary policy. And it can be some way quantified as statement tone. So market expectation of statement tone. On time zero, we receive press release with two things. First one is action. For example, here, the committee decide to raise the target range, and as well as rationale behind that decision. And market reacted negatively, which is expected from theoretical standpoint. After that, we measure the cumulative return for 25 more points in order to make sure that market reached equilibrium price, and in some cases it might be even longer, and related work suggests that up to 40 minutes after event, market is still in with high volatility and reacts to the decision. So yeah, and how we calculate market expectation of action. So as I mentioned already, we can have a price of contract, federal funds future contract, and if we subtract 100 from the price, we will have implied rate. So after that, we, because, for example, today is 21st of January, and we know effective federal fund rate for 20 days of this month. And we use this fraction of months as past as a subtraction from previous month's implied rate that already known, and subtract that part and rescale the part that left to the whole month price and subtract again previous month's price. That would be an option when we didn't have meetings in previous months, and it's consistent with related work and offer the way to measure a market expectation of action. For the tone of the statement, we use ordered probit model with following parameters as previous statement tone, purchasing manager index, expectation of inflation for the following 12 months, as well as slope of yield curve. And for tone of the statement classification, which is in some way core of this project, first of all, we have 96 labeled statements kindly provided by Carlo Rosa, which I'm sample for because it's really hard to gather the financial data. And they are classified in two classes. Hawkish statements, which talks about high uncertainties, high unemployment, high inflation, which is considered bad. Neutral statements and dovish statements, which is exact opposite to hawkish, when risk are balanced and unemployment is low and everything is good. Okay, and we have our blind statements from 2011 to 2019, 71 items. And the idea is to train some model that will classify these statements on the previous period and reuse it to classify our new statements. And as well as we have supportive data with 300,000 articles from 2018. Okay, TF-IDF approach. So TF-IDF was covered in previous presentations, so I can just go and say that I've used the base TF-IDF with two options. First one is on financial news articles, and second one's on the only FOMC statements. And following is dimensionality reduction. We have not that much data point, and if we will put a lot of features in model, the result might be unreliable. I've used truncated SVD, and 7 largest components explains depending on setting from 40 to 47% of variation in data. And after that, I've applied multi-class logistic regression on the data to classify the model. Alternative approach is to use parrot language model. I don't want to go deep in that because it's can take a lot, but the idea that they train on the 2 large corpuses, one of which is Wikipedia. After that, they pre-train the model on the, for example, task of masked LM, where they mask randomly some percentage of words in sentences and provide it as input and predict the word. That is pre-training, and as a fine-tuning, we can add softmax layer at the end of the model and use our labeled classes to predict the results. So, and with all of that, we have our event study pipeline where we have monetary policy action from Federal Fund future minus actual action which is received on time 0, and that's a future monetary policy shock. Second thing is new shock, which is our classified statement minus expectation of tone from ordered probit model, and we can use ordinary risk squares to with targets that is cumulative return in the 30 minutes time frame from -5 minutes to 25 minutes after the event. So about the results. But before that, I would like to give clear understanding which part of this work is mine and which is from the related work. So general pipeline is from related work, and as well as expectation of tone of the statement. And I've used more modern technique for expectation of policy action, and the statement classification were done in accordance to West NLP practices and unrelated to the related work in econometrics. So results. I've evaluating this pipeline piece by piece. And first piece is monetary policy shock evaluation. We using as a reference a model from Carlo Rosa, which spanning from May 99 to June 2007, and it explains monetary policy shock explains 1.3% of variability in data via adjusted R-squared method. On our time frame, the model built by the same principle, which is ordinary least squares with heteroscedasticity consistent standard errors. It explains 3.1%, and I cannot really say that it's better or not because we're using different time periods, and there were different underlying economic situation, and it might be unrelated, but our model is explains more variability in the data. Second thing is like case. So again, December 19 meeting, our model suggests 25 basis points price easing will increase price by almost 1.5% in 20 minutes after event. So on that meeting, the expectation of market was 90 basis point tightening. Actual action was 25 basis point tightening, and this difference, which we call shock, is minus 6 tightening. 6 basis point tightening, which resulted in a decrease of index in 0.06%. So about tone statement of classification, we build confusion matrix and compare with our results in a way with the human who evaluated that data, because for this particular task, there are no classification in the related work. So our results were between TF-IDF built on statements and TF-IDF built on news. TF-IDF built on monetary policy statements acts better, and I assume that might be related to the fact that news data set on the spanning for 5 months of 2018, and not all required data might be in there. And accuracy was of the best model was 79%. And the case, so yeah, and before I move to the case, I would like to note that that was for half of label data point and evaluation of half of label data point. But when I trained on the whole label data and tried to evaluate the blind data, I've received the mono classification. So our TF-IDF model wasn't able to properly classify the data, which is more distant from the data on which we've trained. We will discuss that in limitations and conclusions. As well as BERT, BERT wasn't successful due to quite low amount of data, and I wasn't able to find label data that replicated a good enough financial state, and in order to fine-tune that model, so deep learning was in a way unsuccessful. So the case, on August 21, 2011, we've had in old statements the following words, which is like the last thing is important for an extended period. But in new statement, the extended period became certain, which is reacted in the highest volatility on our analyzed period, and index declined on almost 0.06%. So about contribution, first of all is required data were collected, which for without any payments. Some offerings from data providers companies require starting from $500 payment, and with our research budget it was unfeasible, and the data were collected using a lot of scrappy techniques, which will not cover it in this talk, but I consider that as a significant contribution. The second thing is we were able to classify FOMC statement on label data with 79% of accuracy, and we were able to partially built econometric model with only monetary policy shock, which explains 3.1 variability in data, but we were unable to assess the new shock because we had mono classification on the more recent statements. And answer to research question is yes, we can, but that's not help us to resolve more broader problem in current setting. So about the limitation, I attribute this limitation to the change in the nature of FOMC statement which is covered in the related work. So from this image, I can comment that FOMC statements increases in size with time, and the complexity of how it's hard to read for human to understand what's written in there rises, and it is discussed in the related work. And as well as for the period on which we trained, the most important tone was about price stability, about economic growth, and so on. But contrary for our more new data, the US Central Bank talked more about labor market and unemployment, because after crisis period required them to target different problems, and different words became important, and that's why TF-IDF could not handle well with classification of that more distant data. And for the future work, I consider that it's prospective to use deep learning techniques that learn based on a lot of different data. And if we fine-tune BERT, for example, or more state-of-the-art models on that, we will be able to understand context. With such low amount of data is crucial, as well as we can split the statements on sentence and classify each sentence, and that way we can get more data, but it will require a reliable all data set, which is hard in this domain. And another thing, we can train only iteratively by so we predict only the next statement from previous one and then rebuild model. That might be useful, but I didn't try that. That idea came to me after I submitted it. And there are two questions that I can distinguish out of my reviewer suggestions. So first one is, why did the author choose monetary policy announcement as opposed to other events? So United States monetary policy is quite advanced in comparison with another central banks, because they provide at single point of time, they provide clear rationale behind their decision in the form of one single text. So press conference which is held after that is not that containing significantly new information. And that's the point where I'm sure that in this data is contained the all important information that I need to know and make prediction based on that. And that unique case, because when we're talking about, for example, events of announcement of macroeconomic indicators, they are not that great in the way they release in single number and that's it. Here, there is some text with rationale which can be used. And the second question is, why did central bank policy statements become so important in the aftermath of the financial crisis? Well, it started long before that. In 1994, Federal Reserve started to provide clear announcement and introduce transparent and clear communication about their future decision. But after 2008 crisis, the interest rates became close to zero, and they cannot bolster up economy with interest rate. And they tried to use alternative approach, which is called forward guidance, which is basically write in statement all their expectations, and that way market will expect what's happening next. And the second thing is quantitative easing, which is increasing monetary supply via printing money and buying securities, which also another approach which was useful with near zero interest rates. So I think that as an aftermath of crisis, that all contributed to the rise of importance of policy statements. And thank you. That's time for questions.
Questions? First question is, you are interested only in short time effect.
Yeah.
But what about long time effect? Because short time, as you showed, it has very short period, but then it changes dramatically. So it's not.
Yeah, so there is a thing called efficient market hypothesis, which states that each not news, but any change in the underlying condition is consumed by market instantly. That's a hard definition of that problem, and not all people believe in that. So usually they say that over long term, market became efficient. And I've used 25 minutes frame after the event because consistent with financial event studies that were conducted, which what they basically perform, they calculating some measurements on this period and compare them with the same measurements on completely different period, not completely, but the same day of week, the same time, and compare between them. And that results from related work suggested that increased volatility and consumption and reaching new equilibrium of price is valid for the following 40 minutes after event in this particular task by econometric literature. So that's why I work with that. And 25 minutes were chosen to be consistent with other related work, and as well as my own analysis showed the like on the short time, that's the best cutoff point for in order to have on average have maximum effect. Maximum change of market. So I've done some simple averaging, but that also consistent with related work that I was comparing with.
And another question here, concentrate on Federal Reserve statements. Yes. But in other countries, the whole statement format can be different, and also the central bank can have, as it actually showed, can have different tasks, different say force that they can make enforce the policy on, and if different, this may have different effect. So in different countries, this may lead different to the same analysis may lead to different outcomes.
Yeah, right. So there was one related work from Australia where they compared kind of similar economics, New Zealand, Bank of England, and actually Australia and some other, but they compared, and the thing is that you're applying when you're applying the econometric approaches, they can be reused because you can compare numbers. So this action in this country contributes more, this contributes less. And about the approach of assessing actual classification of tone statement, I agree that we cannot reuse the statements from different countries because it's completely different macroeconomic environment, and the data, unless we collect from each and every country and try to do something with it, but it's topic from completely another research, and I choose. So that was an idea to use National Bank of Ukraine data, but our Ukrainian policy is of producing the statements, and best practices in the central banking world is not that not have that much history as US based. So US central bank started releases from 1994. In Ukraine, we had like fixed exchange rate policy till like I remember that time. So that was not that long ago. So that's yeah. And so the idea basically is the United States is the most rich from data perspective, and that's why I've used the data. And I'm not sure that this pipeline can be reapplied to another one, and it can lead to completely different results.
So that was actually my next question. Can you transfer these two?
I think this each transfer from US based to Ukrainian to Belarusian to any central bank is completely
extreme.
Yeah. So
in the middle.
If you're talking about, for example, European Central Bank, I think it's feasible to do such research because they also have a lot of data. But as I showed you, so why not European? But that in the first case that I showed, so in United States, it's single event. In 2 p.m. we're receiving everything, right? But from ECB, for example, for this particular case that I showed you, here, the release of statement with action was at 2 p.m. and a press conference with informational component was on 2:30 p.m. And that's two different events in terms of any research. So although it was an idea and motivation behind this research, but I could not use this pipeline here. So that would require like convert audio from press conference to some kind of series of text and in real time evaluate the tone. And that's like completely different set of approaches.
Questions? Yeah. Basically, I have a question related to classification task. Yeah. So, as far as I understood, you run four like, experiments in parallel. One using TF-IDF on the statements and news, and similar for using BERT.
One mark, so no news statements for BERT because like I just used Corpora for TF-IDF of news data, but for BERT I have not any labels for financial news data, so they cannot be used there. But everything else, right?
Yeah, but how did you first question? How do you use news data? Because this is not like statement that's okay. We have statement, we have some reaction. That's okay. But how did you merge this data together? Because there is no like different amount of data might be before different labs in your classification problem. This is first question, and second one, you said that BERT model doesn't work good. Yeah,
it doesn't work
because of data. So probably you choose not the right. It's too complicated. This is TF-IDF. This is BERT. Probably would be better to test something in the middle.
Yeah, I just like so I use straightforward approach for deep learning. That wasn't really a lot of work done in that. I just have a feeling that this is the way to go further, because when you use TF-IDF, it's just word counting, but we need to understand context behind it, and humans really understand it. So that was first shot. It didn't work, unfortunately, and I think that's the way to go further, but at current state, I cannot prove that. And I agree that there are a lot of things that might be done and other models that can be used. And as for TF-IDF question with the news, the way I use them, I just use them as corpus of data, because financial news can stay like monetary policy statements is subset of such financial news because it's in itself financial news. And I just wanted to use a more larger corpus in order to have like frequencies of some terms in the so we have economic terms like unemployment. It might be small fraction of larger news corpus, but it's mentioned almost every time in the FOMC statements. So in order to like, this is specific like for comparison of that approach and approach with news, I've just built count of words on that data, and that transformed all monetary policy statements based on that, and the policy statement was not included in the corpus. They were only transformed by that word. So if there are any words that appear that is new in monetary policy statements and not in news data, it will not be counted because there is no representation. But what I mean is that I've used another data to be more accurate in terms of pipeline, because with monetary policy data, we can introduce some data leakage when we build corpus on frequencies from future. And that's why I try to use this different data. But that's also questionable because news from 2018, and they know something that is in there. So that's like a lot of restriction for me from data that I were able to gather, and if there was all data available, I will probably choose a different one.
More questions? Yeah, so back to this scale when you're talking about 25 minutes and 40 minutes, as far as I understand, there is some research behind it and motivation to use exactly this 25 minutes window plus 5 minutes before. But my question is rather different. So, for instance, if I want to play with different time scales, time windows, I would say. So, what will be the benefit and costs for your model? So, for instance, if I extend, because you mentioned that there are some research for 40 minutes, for instance. If I extend this time window 40 minutes, in terms of complexity, does it change anything?
In terms of my implementation, there's like kind of simple models, and it's not hard for cost computation. I think it can easily be changed for 40 minutes, but the thing is that the most impact that we have is on the first minute. So like this initial reaction is the largest one, and all reaction after that gradually will become more unrelated to monetary policy event. So I don't know, stock contains 500 companies. Our macroeconomic news with FOMC statement affected the first 40 minutes, but after that, some news about guy was poisoned by pizza drops thanks one of the pizza companies, and it affects the whole index in some way, and there are a lot of unexplained variability. So my action explained 3.1% of variability in data, and for related work, when they included this news shock, there was 20% variability in data explained. But there is at least for the state of the art, more 80% of data that should be explained. And gradually, the longer time window we will take, the less we will be able to explain, because other events, this global market, interfere with that.
Okay. One of the contributions you put that about data gathering.
Yes.
A lot of involved, and it was hard to obtain. So, will you publish your data?
I cannot do that because of the restriction. When I've scrapped them, I've signed some forms, but the idea is the following. When I've done this research, I Googled, read papers and so on, and investigated the environment. And the answers to the question I've asked, I found, and they was wrong and outdated starting from 2000. And I mean, they were outdated at the moment when I needed them. So the contributions that I mentioned is any person who will have my thesis and will read the data set obtaining section will be able to, at the moment when I've done it, so that's a fresh thing, and it probably for a year or two, or while varchart.com will live, and doesn't change their policy, will be able to go insert their credit card without any payment and scrape the required data using my approach. So that's a contribution which was
rather receipt of data.
Yeah, that's a receipt. I cannot release the data itself. I cannot like release a governmental form statement, but that's one-day job. Anyone can do that. But for the stock data, especially intraday, because end-of-day data is much more available. But for intraday data, which is like for each minute we have opening price, lowest price, highest price, and end price. It's really hard to find. So it's like not hard to find, but hard to find it for free for individual researcher, because large United States-based institutions have licenses and can buy this data because that's their business. The universities have like top Yale and so on universities has access to highly restricted databases that designed especially for research, and they not accept individual contributors. So there is the data and it is stored, but it's the point is that it's hard to find for individual researcher because everyone assumes that you want to make money on it and want to make money on it.
More questions? I have just one question. I'm happy if you stay with the US federal part, not transferring this stuff to Europe. I'm curious about trying to put your pipeline upside down. Please speculate if it will be possible. What if you take a time series, look for characteristic shapes, and predict the memo by the federal part? Would that be possible? Or would you need on top of the approach?
So generally, like directly providing answer to your question, I know about research and general buzz in this prediction of stock market. There was a Kaggle competition called 2 Sigma, where they were provided by news and the stock prices, which were extremely high quality. So news sources Thomson Reuters, which one of the best one, and they don't need to scrap them. And the stock market data were from like another reliable source. And the outcome was that top contributing models that were achieved the highest accuracy were didn't really use the news. And there was a comment from top submissions that is actually easier to predict the news from the stock market than otherwise.
Brother, speaking about that prediction, the note issued by the Federal Reserve.
Generating like text?
Yes, I would be happy to know what they have written in there without reading.
So from knowledge of different diplomas, I knew there's a lot of advancement in generation of text. I read a lot about them, but I would say that from stock market, from indexes, and from text of previous statement and the input. So by indexes, I mean the key economic indicators that are like when statement is produced, they basically what they do, they copy paste previous one and change it according to the change of.
To pre-train the model would be an easy task.
Yeah, and it just need to adjust some couple sentences.
To detect the event, put it on the top of cut and paste it previous model.
Yeah, I think that's an interesting task that probably can be done, but and we can predict and then compare some Hamming distance between two texts or some other distances, and that way learn our approach. So, but we will face the same problem with the amount of data. So we have 96 items, and that's no way to train a deep learning model.
Yeah, when we go to Yale, let's use the corporate submission.
But they still don't have all the data in the world.
Any more questions, gentlemen? No? Thank you very much.
Thank you.